have it. Hey, what's up? This is Rob and...
Oh, me. I'm Stephanie.
Yeah, that's Stephanie. So this is our, every other week video that we do? Every 2 weeks?
Yeah. You guys want more? You better let us know.
Yes, please do. But today, so we've talked a couple times about credit, and we're going to talk about it in a roundabout way today, because one of the things that we've talked about off camera is factors that affect, and you brought this up to me, factors that affect an interest rate. So, you know,
I totally cut you off in the last video.
So that's how this came up. After last video, she's like, "Oh my gosh, I'm so sorry I cut you off." I'm like, "No, it's."
I wasn't really sorry, because let's face it, it's all about me, anyways.
No, totally fine. And I didn't even see it as that. But anyway, one of the things I said in the last video was that there are at least 9 or 10 factors that affect an interest rate.
Yeah, so I didn't know that. I really thought that you come in with a certain credit score and that determines your interest rate. Now, before we even get into this, I just want to know, like, is this on just, like, so the company that you work for is OVM Financial, but there's tons of mortgage companies out there. So what you're going to tell us about, is that across the board?
Yes.
So, like, every mortgage company has the same factors?
Absolutely.
Okay, because I think that's important.
Yeah, it is important, because a lot of the videos that we see out there are really specific to that company. We try to be as general as we can, as educational as we can, to make sure that we're putting out good information and relevant information. But yeah, the biggest, these main factors, just like any end investor, they price it out based off of the overall risk profile. Right. So, if you think about it from a logical standpoint, the more risk on a loan, the higher that interest rate is, the risk and the return for that. Somebody who fits a really, really nice and concise credit profile and some of these other factors that we hit, really are less risk, so they get a lower interest rate. Right,
because you guys have to remember, when we're talking about credit, that's exactly what the credit score was designed for. Absolutely. Was to be able to identify your risk to a lender.
Yes. Yes.
Okay.
And absolutely, so the first one, the very first factor that does affect it, which we've said a couple times, is credit score. I mean, that's the whole model is the whole credit score model.
Bad credit sucks. Just saying.
It is based on assessing the risk of that particular person, whether it be for a car purchase, or whether it be for insurance, or even security clearance.
I know a lot. It's bad. It's bad out there.
Especially in this area where we have a lot of defense contractors and military personnel.
They're checking your credit score for you to get a job. Period. Now. Yeah. So.
So first and foremost, credit score. The higher the credit score, the lower your interest rate is going to be. It's one of the contributing factors there. Okay. The next one, which a lot of people don't know about, is property location. There are certain states that the legislation within those states, as it pertains to mortgages, actually jacks up the interest rate a little bit. There are certain states that make it a little bit harder to close mortgage loans, or they have an excessive amount of litigation that causes those interest rates to hike up a little bit.
So watch where you buy a house?
Yeah.
Now, are you guys required to disclose that, or to tell somebody when they're applying for a mortgage, hey, you may want to reconsider?
No, because typically we're not as OVM. We aren't licensed in a lot of in those states.
Okay.
So we tend to stay out of those states, because they do make the process a little bit more cumbersome. Okay. And make it a little bit harder to close loans there. Okay. The next one is home use. So if you're buying it as a primary residence, it's a little bit less risk. You're going to be there every day. You don't want the house to be foreclosed on, so you're going to make the payment. So there's
if you want to live
there. Also, there's secondary homes and investment homes, and you think about it as the further you get away from it being your primary residence, the more risk it presents to that overall investor. So an investment property, while typically somebody who has an investment property is a little bit more historically financially stable, it presents a little bit more risk, though, because if you don't get the rental income, you're probably not going to be able to afford that property.
And they have new, I think it was the beginning of this year, they had a whole bunch of landlord laws now where it's like damn near impossible. Ooh, I swore. Sorry. But it's impossible to get people out of a rental.
Yeah.
It's pretty bad now. So absolute risk.
Yeah, so a little bit more risk there. The next one is property type. So single family versus multifamily, 2 to 4 units,
Okay.
like a duplex or a quadplex. Condos. So there is a bump, at least on our pricing, and I'm 99.99% sure it's across the board. Condos are a little bit more risky.
Okay.
Because inside of a condo, the performance of the condo association, the performance of your neighbors determines whether or not that condo is still viable. Because if all of your neighbors go under, then it could essentially affect you as that condo owner.
Okay.
Yeah.
All right. So be careful of those condos.
Yeah, condos.
Okay.
Well, and that's why the process for a lot of, say, for conventional loans, for example, conventional loans again a little bit easier, but even on FHA, there's some condos that aren't FHA approved. So FHA doesn't want to lend inside of those condos. So it makes it even harder for them to sell those condos and to move those condos. So if you buy a condo, there's a lot of things that go into it. It's a little bit more risk there. Mobile homes as well.
Because they're going to get blown over by tornadoes?
They could possibly get blown over by tornadoes. That could happen. There's insurance for that. But
Sounds
that's okay.
really bad. I didn't mean that in any
No, and
Wizard of Oz way.
No. And I do a few mobile homes here and there, and the one thing that amazes me is that that it is on a permanent foundation. That's what most of the lenders require, but who's to say that doesn't pick up and move away at some point? So there is a little bit more risk there.
Okay.
Down payment amount. Down payment amount is huge. So again, if you're thinking about it from a risk profile.
Yes. So I totally cut you off again.
No.
I'm going to do this a
You're
lot.
Good. She's good.
That's one of the things that I have been having conversations with people about is, so I read this book and you guys can pick it up. It's called I Will Make You Rich. And
Okay.
It sounds like a cheesy book and he designed it that way. And I think I've talked about that in some of my past videos. I've actually shown the book. But one of the things that he talks about is as parents, teaching our children to save for a down payment on a house like when they first start working, so that way they can have better interest rates.
Absolutely.
Yeah, so save some money.
Yeah, so that's super important. I mean, somebody that is, some of these first-time homebuyer programs that are, no money down, 100% financing, a little bit more risk there. So the interest rates typically account for that. You have somebody who's putting 20% down. That's always been the magical number, right? Everybody thinks in their head they've got to put down 20%, but you don't necessarily have to. It's just factored into that risk profile. Again, one of the contributing factors towards a loan.
Okay, cool.
So the other one is loan features. So term. I just priced out a 15-year rate that's significantly lower than a 30-year rate.
Why is that?
Because you're paying it back quicker and there's overall a little bit less risk versus a 15-year versus a 30-year term.
Okay.
So
like less things are going to happen in your life in 15 years?
Possibly, plus you're chipping away at that you're gaining equity, you're chipping away at that principal and interest.
All right.
So in essence, on a 15-year, you're gaining equity quicker.
Okay.
So again, a little bit less risk because the payment is amortized over a shorter period of time, so the payment is higher.
Okay. Cool.
Interest rate type, is it an adjustable rate? Is it a fixed rate? I mean, there's a lot of different nuances in there. And then inside of your adjustable rates, not only do you have a 6-month and a 1-year adjustable, so they adjust on those periods, you have kind of a hybrid fixed rate and adjustable rate where you have a 3-year. It's a 3-1 arm, so it's fixed for 3 years, and then it turns to an adjustable. They have a 5-year one. They have a 5-1, and they have a 10-1.
That was like the whole housing bubble.
Well, yeah, and it was a way to access a lower rate, and it typically is a lower interest rate introductorily. Is that even a word? Introduction.
Yeah, that one.
The beginning, in the front.
In the beginning, the loan rate is this much.
Yes, but a lot were done on short-term fixed rates because they are a little bit lower on the introductory rate. Then once it turns to an adjustable, it can accelerate depending on the economy, depending on how things are going.
This is going to have to be another video because I will tell you that
Cool.
I spoke to a loan officer earlier here, and we were talking about, so look, guys, I don't know loans. He's using these 3-letter words that I don't know. FHA, VHD, that's
Yeah.
like 19. I don't know loans. I know credit, but I was talking to a loan up. So I have the stigma that everybody else has when they read the news, and like the world's going to explode based on
Sure.
Revolving interest rates or whatever. And I was talking to a loan officer, and I said, well, you don't never get an adjustable mortgage. What are you doing? And he said, if you're military and you know that you're going to move in 3 years, why would you not?
There's a short-term impact, and a lot of times it's one of the things we do as loan officers is really try to understand. I mean, because we are 6 features into this, and there are so many. There's been all these variables that affect an interest rate, and it really comes down to what is in the overall best interest of that client.
Right.
So it's not just and I guess what sparked this in our conversation was people ask me all the time, "Hey, what's the interest rate?" There's not one answer. As you can see, so far we're on 6 or 7 or 8 or something like that, and all these things contribute to it. Well, it also depends on what your plans are. Is it what your long-term plans are? If you are military, it may make sense to go into an adjustable. In most scenarios, it doesn't, because the military person may say, "Hey, I'm moving here. I spoke to one this morning, moving from California to here, and because he is getting orders and doesn't want to sell this property, he's actually keeping it as a rental."
Okay.
So he's using his VA eligibility. He's used his VA eligibility in San Diego. He's in San Diego, and moving here and going to be able to use his VA eligibility here. But if he were on a short-term arm, a 3-year or 5-year arm, once that thing starts going to the adjustable period, then you might want to look at refinancing and making sure to stabilize that payment.
Refinance is a big deal once that, because I know that my mother-in-law, who I hope to God is not watching this video, so I'm getting ready to talk about her.
Plug your ears.
Oh, sorry, Pam. My mother-in-law got sucked into that, during that time period. She got sucked into that, do the interest-only loan where you're only paying the interest, and then, the bottom fell out and her loan payment doubled, and she was like, what the hell am I going to do now?
Yeah,
She figured it out because she's a smart woman, but yeah, I mean, those options are still out there, and you have to find the right loan officer to not mess with you and get you screwed later on.
The interest-only payments, were meant, the way they were abused, I guess, were getting a lot of people into bigger houses that they couldn't afford.
Yeah.
So the loan programs themselves were designed, were flawfully designed. Flawly designed. I'm totally making up words.
We're making our own dictionary.
I don't drink coffee, so I probably need some. But they were poorly designed to allow people to get into more house than they can afford, and that was the way that they could do it, was simply by paying the interest and not chipping away at the principal.
Okay, cool.
One of the other things that affects your loan, your interest rate, is how many points. A lot of times.
You say points like it's a game.
Points. There you go. So that's good. So points are a percentage of the loan amount that you want to pay in order to buy.
I don't want to pay the loan amount. I don't even want to pay my loan off. Why would I want to pay a portion of it up front?
So some buyers and some people like to pay points and upfront costs to lower the interest rate.
Is that smart?
Depends. It takes an analysis. Yeah, there has to be an analysis there to figure out, what's the cost benefit of doing that. Many times, the difference between 1/4 of a point is on your rate. So the difference between 4 1/4 and 4% is only like $5 to $10, maybe $20, $30, depending on the loan amount, each month in your payment. So, really that set on getting a particular interest rate. Like, I've had buyers before where they didn't care how much they had to pay. They just wanted this interest rate because that was in their head. They wanted the 3.5% interest rate.
All right, so I've done some videos about this, and I'm again going to cut you off.
No.
So I've done some videos about this. I found one in particular. There's a website called bankrate.com. where you can put in this information. So what we've gotten away from it in the U.S. is, back in our parents' days, they used to not only look at what the loan was, but what the loan was going to cost.
Right.
Because let's face it, or maybe some people just don't know, just because I borrowed $200 for a house does not mean I'm paying back $250,000.
Correct.
I'm likely paying back $300,000 to $400,000, depending on what your interest rate is, which is why this is such a big deal.
Sure.
To talk about interest rates. But you can put that information into Bankrate and see how much you're actually going to have to pay. Mm-hmm. And one of the things that I really think when you talk to a loan officer that you guys need to talk about, or maybe it's a title, because I know when I went to title, I was the girl that we did title with. I love her. Her name's Stephanie, over at True North Title. And we just laughed through the whole thing, and I signed my name, and I was like, I wasn't paying attention to anything.
Right.
But there's like a list in there, this is what you're going to pay. So if you're going to pay prepaid points, I think you need to consider, okay, how is that going to affect what you're going to pay over the life of the loan? Is this actually worth it?
Absolutely.
If you've got a good loan officer, I mean, you'll tell. But
yeah, you explain it to them. You try to get them to understand the impact from the long-term perspective, and also what their goals are. If they know they're only going to be in this house for 10 years, does that $25 a month savings really impact them versus the cash that's out of their pocket, and maybe they need to buy new carpet or redo a bathroom or something like that. So it all kind of fits in together. Really, when you talk about interest rate and somebody says, hey, what's your rate? It really is about putting together a puzzle. And it's really uncovering a lot of wants and a lot of needs from that buyer to understand, try to put together a complete financial picture so that they really understand
I guess
what
you
that
have
looks
to
like.
know. So I love this, and I've got another idea for a video.
That's good.
We're going to come up with a checklist for you before you buy.
Sure.
So you see the generic ones out there that are like, okay, what's your future plans? Make sure you get these documents in order. Make sure you know this. No, we're not going to do that. Let's talk about where do you want to go with this?
Right.
Before you buy a house, before you buy a car, before you sign up for a credit card, I don't care what it is, where do you want to go with this? Because it sounds like determining your interest rate is based on, hey man, you going to sell this house to put your kid through college?
Right.
We probably need to know that. Is your kid 15?
Yeah.
Because that's 3 years.
Exactly.
And then he's going to go to school. Is your kid, just born?
Right.
Hey, we got him longer. That's awesome.
Well, that's why we as officers work very well with financial planners, because we understand the value of the money and help become a piece of their financial puzzle. Again, not the entire puzzle, but we're a piece of what they're doing. Are they saving, and not only that, do they have access to retirement funds and things like that? Because if they do, that might be a source of where their down payment comes from. And their financial planner, have a really good one, Sean Gillespie, that is a friend of mine from the Naval Academy.
See that day?
Who works?
The Naval Academy.
who works with a lot of veterans. Well, Sean and I talk about, when he sends somebody to me, we talk about the value of that money and if it makes sense for his client to do that, or to refinance, or to even buy that second home, or buy a new primary residence. So all of that plays into it. Again, so when you ask a loan officer, what's your rate, or what's the rate? A lot of what you see online is usually the best case scenario. It is the ideal borrower, an 800 credit score, putting 20% down with no debt, and buying a normal house in the middle of America. That may not apply to us. That may not apply to your situation.
I live with cows.
Yeah, and not only that, when you go on different websites, I would encourage, that are quoting rates, I would encourage you to check the fine print, because it's a very, very prominent military-related website or military-related company, mortgages, that always buy down the rate and charge a point to a point and a half, so that the rate looks even better. So I would encourage you to make sure you read all the fine print.
So that's like the loan documentation. I work with a lot of loan officers, and they obviously, this is business. You guys are running your own businesses, and you have to make it draw the borrowers in. But like I saw one this morning, somebody posted they had like a 2.87, something like that, interest rate, but didn't say how the person got that interest rate. Because to me, if I'm like, 2.87, I'm going to refinance right now, that's
So
all of these factors go into that interest rate.
I'll date myself a little bit in that when I was starting in the mortgage business years ago, it was the interest rates were in the 9, 10, 11, 12%.
My first mortgage was 7.25.
Yeah, well, I was way ahead of that, way before that. But we sold a lot of adjustable rates to get people into the 8, 9% to keep it under 10%. But what happened was all of these mortgage companies back then, you would fax out your interest rates. So you'd fax out your rate sheet to everybody to try to get I was on the wholesale side of things, so I was faxing things out to my mortgage broker, all the mortgage brokers that were sending me business and using my money to fund their loans. It was always best case scenario, and all of these mortgage companies would, even when they posted the rates in the paper, I was in charge of that back when I was working with for Alan Miles, who's our COO here, and George Temple Sr. We would have to post the rates in the newspaper. It was in an ad section. Well, everybody put the lowest possible rate.
Yeah.
It's absolutely
marketing,
I guess is the nicest way to say it.
Marketing versus reality.
So there are two more factors I wanted to cover real quick. One is loan amounts. So if I think there was a lot of people a lot of loan officers, if you're connected with them on Facebook, put out the new conforming interest rates, the new conforming loan limits. I'll do another video on that, on what that matters.
What that means.
Yeah, so basically,
means you can buy more house.
Means you can buy more house with just 5% down. Once you get into a jumbo loan above the 510 in this market, then you have to look at putting more money down, and it's a little bit more risk, so it's a higher interest rate. Credit score has to be higher. There's a lot of things there, but those loan amounts are important. So if you're below after January 1st, well, 43,450 now, above in January above or below. If you're below the 510, you're good. Everything's fine.
He's talking about hundreds of thousands of dollars,
hundreds
by the way.
of thousands.
Not $510.
No.
500,000.
We don't want to.
510,000.
Yeah, that
one.
Number. And the last one, which we decide help decide what those options are based on the loan criteria, but the actual loan programs. VA rates, and federally insured FHA rates.
We're going to do a video on this, by
the
way,
we
so
will.
we can identify.
We'll clarify all that.
What.
But typically those are a little bit lower on the front end because they have a mortgage insurance premium that you are charged.
Right.
So a little bit more insurance built in.
But VA doesn't have that.
VA does not have that. They have their VA funding fee.
Right.
The conforming interest rates, meaning if you're not going VA goodness gracious, VA or FHA.
See,
you're
even
doing,
loan officers get
it's a mouthful. If you're not doing one of those loan programs, typically your conforming rates are a tick higher because FHA, the Federal Housing Administration, is not involved in that loan.
Okay.
So a little bit more risk there. But there are so many more features we could go through and things that impact your interest rate. What we wanted to talk about today was really that we had talked about this 2 weeks ago and hadn't expounded upon it.
Because I cut him off.
So we wanted to make sure we covered that. There are probably 4 or 5 other things that really impact those interest rates.
Okay.
So you're talking 10, 12, 15 things that can influence an interest rate. So when you say, hey, what's your interest rate? That's like asking me what the rest of the chapters of the book are about, because there's so much more involved than just, hey, here's an interest rate. Make sense?
Yeah, it does.
Yeah.
So what's your interest rate?
I'm
just, okay.
That made me cringe a little bit. No, but if you want clarification on that, I'm going to put my contact information in the description. and also all my disclosures that I need to, since we're discussing interest rates and what
I don't have
impacts that.
disclosures.
She doesn't have disclosures.
No.
So how do you impact this? What do you do, in case they don't know who you are?
I help increase your credit score so you get a lower interest rate.
That's right.
Yeah.
That's
yeah.
exactly right. So
Yep.
how can they reach you?
Can I just say real quick though, because a lot of people, you're hearing all of this stuff and you're like, oh my, I'm never going to qualify for a loan. Well, all this stuff goes into determining your interest rate. It's not going to stop you from getting a loan. It's just going to change the amount that you'll pay for it month to month to month.
Mm-hmm.
You increase your credit score. You make certain changes, pay down principal, all that kind of stuff. The refinance option opens up for you after 6 months?
Mm-hmm. After 6 months.
So you can get into it. Most people can get into a home that don't think that they can. I can't tell you how many people I've looked at credit reports and I'm like, why are you here?
Right.
And then I have to send them back over to Rob. So, yeah, that happens a lot. But you're just repairing your credit score alone is going to change that interest rate and change
That's
those
usually
payments.
the biggest factor right there is the credit score. And that's why Stephanie and I are so close, is because we work with a lot of clients. Even if they don't qualify right now, Stephanie can help get you there. She can help get you to where you can get into the house with a credit score that works, qualify for the loan program, and then we can look at a long-term plan of possibly refinancing and lowering that interest rate. And having an asset like Stephanie is invaluable to a loan officer, because the upfront work that she does to help clients get into houses is really, really important.
It is. And I'm just going to say, look, there's a lot of people out there that say that they can fix your credit, but you need the company that does more than just says, I can fix your credit, let me handle it all. You should be involved in that process. And if you're going to buy a house, you need to be involved anyways, because your loan officer is going to need you to be involved in that process. So get used to confronting what your issues are, getting involved in the process to fix it. Let me help you, help yourself, and then you get to go buy a house. Like financial stability right there. Like you don't have to move your kids out of the school district.
Right.
You don't have to worry about your landlord being a Anyways, so I'm Stephanie Adams with SOS Solutions.
How do they reach you?
757-356-5756. Look me up on Facebook. Look me up on YouTube, Instagram.
Wow, you're everywhere.
I just started TikTok. I don't know how to
what's
use
your,
this thing.
What's your TikTok handle? Do you remember?
Nope.
All right, we'll put that in the notes in the post. I'm Rob Younce with OVM Financial. Thank you so much for tuning in. I see a couple of you. Chris Kane, a former player of mine. Dean Mariano, a friend from the Naval Academy. Thanks, guys, for tuning in, and leave us some feedback. We want to hear what you guys think about these shows, because they're getting a little bit longer. I think we're going to probably move them to some other platforms as well. Mm-hmm. But let us know what you think, because Stephanie and I value the feedback. We talk a lot. We'd love to take some questions from all of you.
Are we going to get a phone and put live answer?
Oh, we could.
Oh, it's about to go down.
All right. Thanks a lot, guys.
Take care, guys.